Well, we don't have too many learning objectives in this chapter, but I would say that the important thing in this chapter, other than really understanding the difference between the retrospective and prospective approaches, is to know the exceptions. And so that's in Learning Objective 3. The process for correcting and reporting errors to me doesn't seem to be that difficult. It seems to be something that you would naturally think of doing, because if you have made a material error, you know your financials would be wrong in the past, and you would also know that there's depending upon when you discovered the error, you would have an income statement effect in your current year. Let's just get right into these problems then. The changes. What are these three types of accounting changes? Well, you have a change in principal, and the important thing here is that that principal has to be acceptable. So it has to fit into GAAP, and generally we're talking about a voluntary change from one method to another method that a company might make. This is not too common, but it does happen in companies. Generally, you keep one methodology and you continue with it. In particular, because of the IT programming involved in all of that. Then in 2, you have a change in an estimate. And this is when new information causes you to revise your estimate. And you shouldn't, that word revise doesn't mean you go back and revise financials, by the way. Changes in estimate meaning going forth, and that's perspective. Then you have changes in reporting entity. That's what makes up a particular company, what is included in the company and what is included in the financial statements. You would change, when you do changes 1 and 3, generally the general rule, this is not the exception, the general rule is those are retros. They require restatements. And when you do a change in estimate, it's considered not to be an error or not to be anything that isn't expected. We expect to have changes in estimates. In fact, if you had a company that didn't have changes in estimates, an auditor would wonder about them. This is prospective or going forth, therefore you don't make the changes. So 1 and 3 are generally handled as retrospectively, meaning go back, restate, and 2 is generally handled as prospective. Now, let's start talking about exceptions. The exceptions to change in principle include depreciation, amortization, and depletion. That is, if you applied those principles properly when you did it, but now you decided that there's an option for you to change to a different way of handling those journal entries. An example, of course, is in depreciation, going from sum of your digits to straight line. If you have an option to go from one method to another, and you take the option and you change to the new method, again, you have to justify it. You can't just go back and forth from one new method to another. If it involves depreciation, depletion, or amortization, it's an exception to the retro rule. And you are going to go forth, and it's going to be prospective changes. So just change the way you're doing it today, and basically you are spreading the expense, the amount that remains to be taken off of the books over the next periods of time. Now, a change in estimate. Almost every example I can think of is going to be prospective. However, as I discussed with you, when we get into compensation and we have the accounts which are paid-in capital accounts, one of the goals you seem to have is getting the paid-in capital account right, whereas the other, it seems to be spread over the period of time prospectively. And it's an income statement. You're trying to get the income statement right. So regardless, changes in estimates are prospective. Changes in reporting entity. Well, changes in reporting entity, you are going to try to make it as if that company that didn't exist existed in the past. It's a kind of what if scenario sort of thing going on there. The exception to this, which also I would say is a change in principle sort of a thing, is when you go from the equity method of accounting to another method of accounting. And you know that through talking about investments, when you had investments in Intermediate 1. Besides the depreciation, depletion, and amortization under changes in principle, the other one is to LIFO, and as I just said, from equity. So you have to memorize to LIFO, from equity, depreciation, depletion, and amortization. Those are exceptions to the principle. Otherwise, it's retro, reporting entity. You need to know that one is generally handled as retro. The exception is from equity. Alrighty. Now here's a problem down here, and it's really getting you to understand or classify what they are describing, and the categories they have up there are a little confusing. One, a change in accounting principle that's handled retrospectively. This is the way we usually handle them. And then 2, they want to know if it's one of the exceptions. 3, they want to know if it's an estimate. And 4, I do not like this terminology. It's a change in estimate resulting from a change in principle. I'm going to say forget about it because I'm not going to use that terminology. I'll explain. Change in reporting entity or a correction of an error. So while we said there was really 3 changes, this is listing out 6 because we also include errors and we take into account the exceptions. And then they have these descriptions, and I'm just going to go down here to our solution because I like the way it's printed out, and I'll discuss these with you. Change from expensing extraordinary repairs to capitalizing these expenditures. First of all, you would be tending to say this is a change in principle. I'm going to say, is it a change in principle? Because if it's a change in principle, you have to go from acceptable GAAP to acceptable GAAP. Are both of these acceptable GAPs? And the answer is no, they aren't acceptable GAPs. They aren't. It isn't acceptable GAAP to expense an extraordinary repair. Instead, it is an error. So the first one, the answer is it's an error. Okay, so it's an error. And there's no exception here for the error. You're going to assume it's a material error, and a material error means they need to go back and they need to change things. They have a whole procedure for it. All right, change in residual value of machinery. This is a change in an estimate, and it also happens to involve depreciation. So this is going to be handled as going forth. It's going to be a prospective, which means as soon as they come up with a new number, they're going to start doing their depreciation differently. Change from FIFO to LIFO. So again, the thing we had to memorize was to LIFO. If it's a to LIFO, these are both acceptable methods, acceptable principles, and what we are doing here is an exception though, because we cannot go back forever to come about with the new numbers. So the restatement is limited in the periods of time in which you can go back and do it. So it is considered an exception. Change in the percentage used to determine warranty expense. This is an estimate. This is an estimate. So a change in estimate means go forward. When we had a problem in here with warranty expense, we determined in the next accounting period that we had to change the amount. And we did not go back and change warranty expense in the previous period of time. What did we do? We put a little bit more in there for this current period of time. I think we also had an example in there about vacation expense and doing a change there. These are changes in percentages. We don't have a crystal ball. It is not an error. It is a change in estimate. We go forth. Change from LIFO to FIFO. It does not say to LIFO. If it said to LIFO, it would be an exception. Because it's not an exception and both of these are accepted accounted principles, it is a change in principles. Change in principles, go back, restate. Change from reporting an investment by the equity method to another method. Okay, so you're going from equity. You're going from equity to something else. Okay, so what do you do if you go from equity to something else? This is an exception. It's an exception to the general principle, which would say you go back and restate. So this is one of our exceptions, just like 3 up there was an exception. A change in the composition of a group of firms. This is a change in your entity. When you change entities, you pretend as if the other entity had always existed. Change from sum of years digits to straight line depreciation. Well, I'm going to tell you that this is the one where they're calling a change in estimate resulting from a change in principle. I don't like that at all. What are we going to say? We're going to say it's an exception to the change in principle rules, and it's an exception to the change in principle rules because it is going from an acceptable principle to another accepted principle, and it involves what? Depreciation, depletion, or amortization, in which case it's a go forth perspective. From FIFO to average. Is this say to LIFO? Did it say to LIFO? It did not. It did not say to LIFO. It's a change in principle, retro, restate. Changing actuarial assumptions for a defined benefit plan. Well, we all know this happens. It just happens, doesn't it? And this is estimate. It's an estimate that we're relying upon others to provide us. When they provide us with this number, we don't make an error. We do our work to the best of our abilities, and we discover that the numbers need to be changed. This is a change in estimate. You are going to go forth. So we would take these changes in estimates and they would show up in the pension, right? Here is again the thing that is very important to go through and to study and to understand. And would say it's very important. 3 types of accounting changes that we're going to understand here. I apologize for this, duplication. Because in your packet you have a table that has been input, and then you have another table that's been input, and these 2 tables are identical. We are saying that the income before taxes is similar to what you had in your PowerPoints. We have revenues. We have cost of goods sold under several different methods. It's probably helpful to note that the difference between FIFO and average, as you can see in 2015, it's going to be 16, and then in 2014, it's going to be 14. And so this is going to be the difference in cost of goods sold, and so would follow through to the income statement. If they give us our tax rate, then you also need to consider the tax in it. So one of the first things you probably should do is to go back and to create those income statements under both approaches, because it's very easy to see the difference, to see how that would look. It says they decided to change to the average method of inventory. So it does not say to LIFO. Because it does not say to LIFO, by the way, you are really going to have to go back and create the financials, see how the financials change, and also go back in and look at the change in your balance sheet and what your beginning retained earnings statement beginning balance would be. And when we see this, you're going to assume that you're going to have to come up with a beginning number for 2014 retained earnings, that your retained earnings statement is going to go all the way through to the end of 2016. One of the first things they're doing is not the income statement, though. They ask you to do the journal entry to make the correction. Assuming they have started this process at the very beginning of the year, then there is no cost of goods sold in which it says up here, beginning of 2016. These differences here in cost of goods sold do not show up in a journal entry. You don't have to adjust your retained earnings up here for this difference, because during all of 2016 you would have used the new method. So therefore there's no adjustment to cost of goods sold. I said multiple times, I think it depends when the changes are made, and starting at the beginning is always best, because then they know that there's only a change for retained earnings and a change in inventory. Now, how do you get the retained earnings number? It is the effect of cost of goods sold differences, and we went back, we said this was 16, this is the 14, and so the costs under the old method, which was FIFO, you'll notice 40 and 38 were all lower than under the new method, which is average. So we need to have retained earnings go down by 16 plus 14, which is 30. And so there's your debit. Then you're going to say, well, what's the other side? Wasn't that going to cost of goods sold? And when cost of goods sold and inventory, well, the cost of goods sold has been closed to retained earnings, and then the inventory, the cumulative effect would show up then in the next year, which is our beginning number. Now, actually, as I said previously, when you have these inventory type things, you realize you're going to have to go back and change your beginning inventory numbers in your balance sheets for those years too. So they're not having you do balance sheets, but you have to understand balance sheet's going to change because they're going to have income, the inventory numbers are going to change, your income statement's going to change for cost of goods sold. In this case, they don't give you taxes, so it says if you had the tax rate, you would put the tax rate in there as well, and you would have an effect on your deferred tax accounts. Well, enough of that. I hope you got the 30 and understand where the 30 is coming from. Sometimes it's easiest to say what is the income statement effect, and then to say what's the other account, and the other account is going to be a balance sheet account. And if it's cost of goods sold, you usually just think of inventory. And if you've got the sign right, in other words, reducing income, so reducing retained earnings, you know the credit's got to be to inventory then. So that's 30. And they've put it in here also to show you. Now, when you do your financial statements, you work through them, and I don't particularly like the way they've done this. I would probably put gross profit in there, and then go to operating, and then go to net income. But the second requirement is to do comparative income statements. And what I would say is they need to say restated. It needs to say restated. So the ones that are redone need to say at the top they're redone. Since they began in 2016 with this new method, then 2016 is not restated, but 2015 needs to be up there on that line. And they didn't do it. They should have. Then the next calculation is to come about the numbers here to say where should we be with our statements, with our retained earnings, and how it affects retained earnings. I guess I should have said also that in requirement 2, Usually, if it's a publicly traded company, you'll have 3 years of income statements, which means 2014 would also be shown, and it would say at the top restated, and it would have the numbers that would have been in 2014 had we always used the new principle. Okay, so in requirement 3 here, the requirement was for us to determine the balance of retained earnings at 2015 as they previously reported using the FIFO method. So they basically want you to go through and say, what would this statement have looked like using the FIFO method? So that's all it is plugging in numbers there. And then in requirement 4, they say, what is the beginning adjustment which is required? And instead of doing that, I think it's really helpful if you go through and you actually do comparative statements of shareholders' equity with this, because what you need to do here is understand that when you started, if you were starting January 1st, 2015, you need to figure out the income statement effect for the previous period of time, and it needs to be rolled up into the beginning retained earnings number. And we said that effect in 2014 was 14. So you need to change from that previous, they said do it using the FIFO method, and that's the one above it. So they're having you do that because they want you to see that that number is going to change. It's going to change from 80 to 66 because in 2014, once that was restated, the beginning number would have been 14 different. It would have gone down by 14. So if you have to go back and do your financials over, and you're going to change your income statement, you're going to change your balance sheet, in many cases cash flow changes, and when you change these, and you're going to change the stockholder equity walk forward because retained earnings changes. If retained earnings changes, then you need to go back to the first date that's shown and put all the cumulative effects into the beginning balance change. Now I like this because they are actually showing you what a stockholder's equity account, not a statement of retained earnings, a stockholder's equity walk forward, a statement of stockholders' equity in your financial statements, one of the 4 required, should look like. Because you put across the top the captions of the accounts, you show the changes, you detail what caused the changes, and it's all done in one statement. Okay, so we in our equity chapter, I don't think we had probably enough discussion of what this actually should look like, but this is what it should look like in the financials. Going on, then, changing the depreciation methods. They used the declining balance, and then they decided to change the straight line. Well, depreciation, depletion, and amortization, all of those changes are changes, which means you go forth. So anything that has to do with that, whether it's a change in estimate or the change in the method, we are going to go forth. So what do? Here's a discussion. Voluntary changes in accounting principles are generally done retro. However, there are exceptions, and the change in depreciation method is considered a change in an estimate. So you change it, you handle it the same way as you would a change in estimate. Instead, the company simply employs straight line method from now on. A disclosure note needs to justify the change and describe the effect on any financial statement items and per share amounts affected in all the other periods. Just like in our PowerPoints, then, what you need to do is say, where are we? And then figure out what needs to be taken off in terms of depreciation. and then figure out how much to do per year. Now the solution has us doing 200,000 a year, and it's 599,000. I'm like, I don't think so, because if I do my math, I get something like 199,667 or 66670 or something like that, or 199,66.67. I don't know, depending on how many decimals you go out. So technically, that's the right answer there. Don't you just love it when the answer key is wrong? So, by the way, the people that make the answer keys are the poor little PhD students. The professors write the textbook and they make their PhD students come up with the solutions. Woodmere introduced a new line of sprinklers, a 1-year warranty. Because this product was offered a warranty, trade publications were consulted to determine the experience of others. They expected to be 2% of sales, and but then in late 2016, they figured out that there was a problem and it should be 3%. And that's what you actually see in front of you. Again, duplication of tables. So it looks like they are recording their warranty expense as a debit, and they're recording their liability as a credit, and then they're going back and they're actually taking it out of the liability account. Seems that their procedures are proper in handling this, but what they would need to do then is note that the amount of warranty expense needs to be higher, needs to be recorded, and then when they take the actual amounts out, they will take them actually out of that liability account. That's all I need you to know with that one. Change in inventory methods, average to FIFO. It doesn't say to LIFO. Because this isn't a change, if they do it at the very beginning of the year, you will not have a change in cost of goods sold, but you need to record. Because it was done at the end of the year, the previous year's cost of goods sold would have been closed out to retained earnings. You adjust retained earnings accordingly. Retained earnings depends upon whether cost of goods sold is going to be higher or if it's going to be lower with this change. So you will change retained earnings. In this case, is going to be increased. And the offset, whenever you have inventory, to just kind of think of, is going to be the inventory account. And so cost of goods sold and inventory are the two accounts affected. Depends on whether you have closed your accounts for the year and when the change happens, whether you take it all to retained earnings or you need to adjust cost of goods sold. Dishes changed method from FIFO to LIFO. Here is the explanation. When a company changes to LIFO, accounting records of prior years often are inadequate. So if it's inadequate and they cannot do it, it's just impractical, you are going to provide that disclosure notes and have an explanation as to why it's impractical, but to LIFO is accepted as an exception. The 4-step process to correcting errors. Here we have a company. What did they do here? Receives royalties equal to 12%, and they pay them on February. The book sales subject to warranty are expected to be $300,000. They accrued royalty revenue of $36,000 and received $36,500. What adjustments should be made to the financial statements? This is our first question. Well, the cash came in, and when the cash came in, it is like we handled our warranties and handled our vacation expenses. You'll have just an adjustment which needs to be done when we receive everything in. We made an error in our amortization schedule. Oh, Lordy, remember those amortization schedules? So the trick to thinking about this is when you have a payment here, a part of the payment is going to go to interest and a part of the payment is going to be to the principal, because this is something that involves a note and it's installment. So a payment which is an installment payment is going to be either applied as interest or going to be a down payment, or I'm sorry, not down payment, a payment which is applied to the principal. That's something to keep in mind when you're looking at this problem. It says, as a result of the error, they understated interest expense in 2 separate years, and the amount in 1 year is $45,000 and the other one is $40,000. So let's look at what we need to do. So what we have here, the error would cause then both of those net incomes to be overstated, because we would have had a problem there with the interest expense not showing up. What they want you to do is what I just was talking to you about, is to think about the journal entry, because the cash payment is going to be applied to the principal, which means it goes to note payable, and it's also going to show interest expense. That's not a part of the solution. That's just kind of explaining your setup for what is happening here. So if the cash amount is right, then you can see that if the cash amount is right, and I'm assuming that that's right, they paid the right amount. If interest expense is wrong, then what else is wrong? Note payable. Okay, so that's the assumption, and it's based upon your knowledge of paying installment payments. Well, if that's the case, you know you got a problem then with, I always said you go back and look at the income statement and you look at the balance sheet. In this case, it's going to be interest expense that's going to be a problem, and the books have already been closed, so we need to reduce net income, so reduce retained earnings by that $85,000. And the other side of it, which happened in 2 separate years, by the way, 2 separate time periods, but since you don't close note payable into anything, it's not a temporary account, you got an $85,000 adjustment, which you need there. The third thing is, what do you need to do besides fixing this? Okay, you fixed the journal entry. What else are you going to have to do? Well, you got to go back and you got to fix your financials. If it's material, you're going to be fixing your financials. You are going to say retrospectively restated. You're going to discuss it, and a prior period adjustment, or you're going to discuss, or you're going to change your first period amount, which is shown as we did in our problem. And there's also the tax effects, and we have not covered the tax effects or included the tax effects in the stuff that which we have in front of you here, but those need to be done.